Good morning. I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategies Advantage. I want to welcome you to today's presentation, which I have entitled, What is Your Next Step? Recently, I spoke in Las Vegas at a conference for DHIA Provo and talked about what I call the 3 pillars of financial success. And I want to go through those and tell you why I think each of those are important, significant, and very much needed for your financial success going forward. And it doesn't matter, I'm going to talk about the aspects of the dairy industry, but these numbers, these relationships, these concepts apply to just about any business. And so I would encourage you to listen carefully. But let's talk about the 3 pillars of financial success. Number 1, protect the balance sheet. Basically, I'm talking about building your working capital. That's the difference between your current assets and your current liabilities. The money you have coming in the short term versus the money going out. Building this working capital gives you a lot of options. For example, you have money, you have cash. It's a lot better than that college situation. You recall, we've all been in this situation where we had to call home for more money, if that was even an option for you. But anyway, where we ran out of money before we ran out of month. That is not a very comfortable position to be in, as you recall. Same thing when you have negative working capital. It gets tough on your ongoing operations and your use of cash or ability to use cash. Second of all, on the balance sheet, keep your loan to value percentages in line. On a dairy, we're talking about less than or equal to 65% loan to value on the herd, less than 100% on the feed, less than or equal to 100%, and less than or equal to 65% on real estate loans. And remember, it's always better to be at 0 than it is at 65% loan to value. But the concept is that's our upper limits. We don't want to exceed those. We get into some inability to potentially service that debt if we get above those levels. So in any way, building the working capital, you have options. Number 1, to expand. Or number 2, if you get into a serious financial downturn, and we've certainly had them in all agricultural industries the last 10 years, off and on at different times, it gives you the opportunity to potentially restructure your debt, to build your cash flow better, and to sustain your operation in the short term anyway. Number 2, I would say build a banking relationship. This is tougher than ever. And why is that? Well, I think frankly that the banking industry has done a lot less training than they used to of their people. So we have inexperienced young bankers, not putting them down, it's just an observation. And there are also good bankers, really good bankers, who are leaving your bank for other opportunities, whether it's at a different bank or a different industry completely. So, best way to maintain your banker, make his or her job easier. How, you say? How do I make their job easier? Well, here's a couple examples. Give them monthly inventories. If you're on a dairy, it shows you the progress you're making on the feed front. But remember, you can actually use feed programs to do this monthly, but it's only as good as the information you put in, the garbage in, garbage out. Put good inputs and you'll get good reports, outputs. So you can share with them monthly, tell them what your position is pretty easily. Just twice a year at least, go through and do a physical count. Make sure that your inventory is in line with what the computer is saying. Because there are some issues with waste and stuff like that, so we want to make sure we compensate for those. Year-to-date cash flows is another thing. And then verify those financial results with CPA prepared financial statements twice a year, maybe at the end of June, the end of December. Keep the banker in the loop and they will be there, he or she will be there when you need them. The key is we need to let our banker know what's going on. Let them know how you're doing, and that will help them. They're your salesman on the loan approval line. They are your salesman, so it'll help them to expand the financing, to expand your operation, for example, or as I said earlier, to restructure debt if we get in a serious downturn and have some real cash flow problems. So That's a summary on building your bank relationships. Guard your cash flow is number 3. I have 5 reasons for this. Number 1, you will feel more in control. If you've ever gotten caught with your vehicle on what I call black ice sneaks up on you and you don't even know that it's slippery, and suddenly you're out of control. Your car is off the road. Believe me, it's the same with cash flow. If you know what's going on, whether positive or negative, you can make adjustments, and the key is to feel more in control. Second of all, talking about making adjustments, as I've said numerous times, if you measure this, you can understand it. If you understand it, you can control it. And lo and behold, if you can control your cash flow, you can make the improvements you need to get ahead of the game. Point number 3, you're going to get more enthused. And you're going to start asking, why would I ever want negative cash flow? And so what do I need to do to avoid that or to change it if it shows up some month? The key is watching it, measuring it. Again, going back to point number 2, measuring, understanding, controlling, and improving it. Point number 4, you will have the tool, if you guard your cash flow and you measure it monthly, you'll have the tools you need to discuss with your team. You can evaluate, why is our labor creeping up so much? What are we doing wrong here? How can we improve that? Get them involved. And the reason that is because they're in your day-to-day operations, they can identify solutions that'll help you. And they want you to survive. Their jobs are depending on it. They want you to succeed. And what's next? What about point number 5? Discuss this with your vendors. You can talk to them about how their pricing or their payment structure may be impairing your progress, and so they need you to succeed and would be willing to work with you. So what's next? If you're going to expand your operation, you need all 3 of these for acquiring the financing that you will need. If you plan to sell, I would suggest focus on the strengths, strengthening your balance sheet, and guarding your cash flow too. And then if you're going to stay at the same time and just boost your efficiencies, look at all 3 and learn where you need to change, where you can make improvements in your cash flow. And all 3 of these pillars, protecting the balance sheet, building your bank relationship, and guarding your cash flow, equal the foundation for reaching your financial objectives. I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategies Advantage software. I want to thank you for listening today. Thank you very much.